My name is Mohammed, not a common name, right? And a huge thank you to Suffolk University's Sawyer Business School for hosting this conference. As you know, arriving, this downtown location is the perfect hub for exploring Boston's innovation ecosystem and learning from industry leaders. The goal behind today's Startup Boston is to connect the entire greater Boston and New England startup community. By the way, I'm from Maine and I'm here. Yeah, so, connecting all you guys, all the communities, all industries, all startup departments, and all bootstrapped and funding stages for 5 days of learning and connecting with one another. So make sure you connect with one another, and Stephanie won't call on you. So thank you for attending this conference. It is a labor of love, and we appreciate you playing a role in shaping our startup community. Also, a huge thank you to, again, Suffolk University for hosting us. It means a lot, and it wouldn't have happened without them. Startup Boston could not have happened without, also the awesome partners that you saw as you came in. And again, thank you, and the season is on. And now I'll welcome Jeff.
Hey everybody, good morning. Welcome to Startup Boston. My name is Jeff Knox. I'm a Senior Associate at InnoSpark Ventures. We are an early stage venture capital firm located here in Boston. As the slide says, we are focused on applications of data science, AI, machine learning. I happen to work on our life sciences vertical, but as a fund, we invest in broader healthcare and sort of vertical enterprise as well. But we're not here to talk about any of that today. Today we're here to talk about understanding your term sheet. So as we head into Startup Boston here, this is the primer that will help you understand, when that VC hands that term sheet to you and says that they want to write you a check, what exactly they're telling you in so much detail. What we're going to be walking through today is really sort of an intuition around what different parts of a term sheet mean. We're going to be walking down sort of the standard term sheet, which is put out by the National Venture Capital Association. It's a very standard set of terms that just says with a whole bunch of blanks in there, generally what the structure of a typical investment looks like. And there's a lot of legal language in there, or what will look like legal language to a lot of folks. We're going to talk about how it's not the final legal agreement. But what we're going to be doing is really saying what each term is trying to accomplish, kind of what the language of it is getting to and what you're sort of agreeing to in sort of the spirit or the thrust of what the document's getting to. So this is meant to be a pretty conversational session. I'll be stopping very often along the way to take questions, and if you have any that you want to jump in with, you should feel free. But a disclaimer first, I am not a lawyer. I am an investor, not a lawyer. So if you are, actually going in and, doing this negotiation, you should probably get some advice at some point, especially if this is your first time negotiating a term sheet. There are plenty of very kind lawyers who are sponsoring this event. The organizers will be happy to connect you to them, but this isn't legal advice, shouldn't be relied on as if it were. Also, all financings are different. We're going to be talking in very, very broad brushstrokes today, but there's, going to be a lot of generalities that we speak in, whereas in reality, any given financing is different. Take that, everything we say here with some kind of grain of salt. Also, all funds are different. Some extend term sheets at different times in their process. Some tweak the term sheet that we're going to talk through today in different ways. You shouldn't assume that necessarily everyone is using the exact same term sheet. So you're going to be hearing one person's opinion on a lot of the things we talk about. Okay, those disclaimers out of the way. I also wanted to cover the different types of financing rounds really briefly. So we're going to be talking about a more generic term sheet today, but it's typically going to be for a priced equity round that you would get a term sheet like the one we're going to be talking about. Also, just to touch on them, there are other types of ways that investments can be made. Notably, today we see a lot of safe notes and convertible notes, especially at the very early rounds that I work in. The advantages of those types of instruments are that they are simple, they are fast, they have less paperwork involved, they minimize legal expenses. For early fundraising, they really do, they get the money in the door with a minimum of, back and forth and a minimum of time. They also don't explicitly value the company. That's important at early stages because often it's very difficult to value early stage companies. They also don't typically create a board structure or governance structure. And with this, one difference between the two, safe note versus convertible, is that safe, which was introduced by YC a number of years ago at this point, doesn't also represent a loan or any equity ownership, by contrast to a convertible note, which is the older of the two types of instruments, which does represent a loan. All the way at the bottom of this, you're going to see the priced equity round, which is what we're going to be mainly talking about today. This is really appropriate for the first really substantial fundraise, probably like a Series A. And this is when we are actually going to put a value on the business that you're building. We're going to say we are buying shares of your business, and to do that, we're going to say what your business is worth and what the amount of money that we're putting in is going to buy us. We're also almost always going to create a sort of board or governance structure, something that decides how this money is going to be used, that looks after the company, that helps make major decisions. And it represents someone on the outside of your investor actually owning a piece of your company. And the standard version of the term sheet that you're going to get for this equity round is what's provided by that NVCA association, and that's what we're going to be walking through today. Any questions here before we jump forward? One in the back?
A safe note, hello. If a safe note doesn't represent a loan or equity, what does it represent? Maybe that's a simple question.
So SAFE is actually an acronym. It stands for Simple Agreement for Future Equity. And so it is a binding legal agreement that basically says in the future, it's typically keyed to a price round. In the future, when you do one of these price rounds and value your equity, we are going to take equity then. And so it's neither a loan nor is it buying equity now. It's an agreement to buy equity in the future. The big difference between a convertible note and a SAFE is that a convertible note is a loan. It has to be paid back, whereas a SAFE does not. If your business goes under, which we all hope it doesn't, but many do, the SAFE does not have to be paid back. Good question.
Follow-up question.
Please.
So how is the equity determined for that SAFE?
Good question. So the question is, how is the equity that a SAFE note buys determined? It can be determined in one of two ways. Usually, the SAFE is going to come with some valuation cap, which says, when you take that equity round in the future, I'm going to take the price that is established either then or now, or at some peak level. So if I'm investing in you now and I invest in a SAFE note that has a cap of $5 million, and later you raise around at $4 million, well, then I take that $4 million valuation. But if you raise around later at $20 million, then I keep my 5. That's how that cap works. That's one mechanism. The other mechanism is what they call a discount, which says, I'm going to take some discount off of whatever your round is later. A common discount number is 20%. So that says, I'm going to give you money now, and when you raise your round later, if you raise at $10 million, well, I get an $8 million valuation. And that's the benefit I get of investing now rather than later. Good question again. Great. Let's keep going. So again, before we get into the sort of technical language of a term sheet, this is sort of a couple sort of disclaimers. One is that a term sheet is an expression of investment interest. It is a blueprint for the investment. It's a blueprint for the governance. It's a blueprint for the rights that investors get. It is not a promise of investment. When someone gives you a term sheet, there is not a binding legal agreement that says they're definitely going to invest. It is not the last word on investment terms. And it's not the final legal document that will govern the investment. It's basically the starting gun of the race. It is the place where you begin your negotiation. It's not the end. And at the end of your negotiation, there will be a sort of definitive legal document. There's usually a couple of them, actually, that will be drawn up that will formalize in a lot of ways the terms that you agree on in the term sheet. But that's just sort of how we should think about a term sheet. It's the beginning of your negotiation. It's not the end. And then, should I negotiate? The answer is yes, you probably should. You're certainly welcome to. Your investor almost certainly expects that you will. Unsurprisingly, the best results typically come when you have good alternatives. And that's competing offers or extra runway that lets you walk away from terms that you don't like. So yes, a term sheet is the beginning of a negotiation. You should expect to negotiate. Any questions here? If not, let's jump forward. And so this is where we are getting into the actual language of the term sheet itself. So for the next several slides, what you're going to see on the left is an actual screenshot from the NVCA, we'll just use the acronym, term sheet. And so you can kind of see how it's set up. It's basically what looks like a legal document with an awful lot of blanks in it. Though that's exactly what it is. That's going to be that throughout. So I'm going to be showing you for the next several slides an excerpt from the term sheet on the left, and on the right, I'm giving you some bullet points that try to get to that intuition of what this particular section is trying to do. So from the top, the introduction, this basically gives the ground rules on controlling law and reiterates that point I mentioned about a term sheet not being a binding investment commitment. This basically says in so many words, like, we are offering you these potential terms. It says, it gives, the ground rules that this is not necessarily a binding commitment on the investor. That's probably the most important thing that's covered here. It typically also contains this provision that's called a no-shop provision that says if you sign this term sheet, you're not allowed to talk to other investors for some amount of time. And that's basically just so that you don't run down the street the second you get this term sheet and use it as a tool to negotiate with your next investor. This is a fairly simple setup, nothing really terribly meaningful in this particular section, but starting from the top, wanted to cover it first. Please.
No shop, oh, I'm sorry. With the no shop provision, then I guess typically I thought people try to get 2 or more term sheets. So how can you do that?
Getting a term sheet is different from signing a term sheet.
Oh, okay.
You should try to get multiple term sheets. That is excellent advice. When you're signing a term sheet, what you're telling the investor is, I choose you.
Oh.
And so that's at the point where you're saying, I've chosen you, we're going to negotiate with one another, and you're agreeing to negotiate with the person that you've chosen rather than negotiating with 3 other partners at the same time.
Will they put a fuse on this though? Like you have to sign it within a week or something, so you don't have much time to sort of react?
Some people will.
Okay.
No, this is where, taking off my investor hat, I would say the number of financings that ever fall apart exclusively because some deadline isn't met, probably small. If someone is really, really excited about your company, they may put some sort of deadline on it, but if you run through that deadline and they're still excited about you, they'll probably still be in touch. So, again, this is where it's very, very individual to the specific negotiations. I would hate to, give you advice that later leads you to lose a term sheet, but I would say that, the risk in there is something that you should think about.
Okay, thank you.
Question in the back?
So following up on that, would you recommend, a certain strategy in terms of like lining up kind of your raise to like get multiple term sheets at the same time? Like, is there a way to kind of coordinate this so you don't deal with that kind of fuse or?
I mean, there is advice. It's not going to be anything that you don't already know. It's that you should talk to a lot of people. It's that you should be really active in following up with everyone that's interested in your company so that you move everyone along at the same time. There is definitely a strategy around it, but I don't think there's any sort of trick that's not obvious. Question in the front? So the question is, how often do people get term sheets that don't go on to legal agreements? That's a really hard question to answer, because when I mentioned earlier that VCs give term sheets at different points in their process, to expound on that a little bit more, different VCs leave themselves different amounts of diligence to do afterwards. Some people check out the couple things that they think are critical and then leave a bunch of diligence to do afterwards. Some people do really most all of their work and give you a term sheet when they're 95% done. And so the number of term sheets that don't go on to full legal agreements is dependent on where in the process they're giving you a term sheet. Remember that, one of the, terms, one of the pieces of this not being a binding commitment is that they have to finish their diligence. And so really difficult to put a number on that. I would say that it is certainly not, it is not the case that every term sheet goes on to a full agreement. I think, you could, if I were to try, I think what you're getting at is, if I get a term sheet, how confident should I be I'm going to actually get investment? And I think if you want to get to that question, the more helpful way to do it would be to ask a venture capitalist something like, how much more work will you have to do after this term sheet is done, rather than what percentage of your investments go on? Because I wouldn't really trust their percentage, and I don't think it would give you a really good idea of how much more work is to be done. I would ask them in a little bit more qualitative terms, and then they should be able to tell you like, oh, I've looked at X and Y, but I still have to look into A and B.
I would want to know that percentage. But I hear what you're saying.
Makes sense. Question off to the side.
So yeah, just when people are asking questions, there's two of us running with the mics. We'll get there as soon as possible, but please use the mic.
Question off to the right.
Yeah, I was wondering, let's say you get 3 different term sheets from 3 different investors, and ideally you want to choose one that gives you, negotiates well with you, gives you what you want. To what extent, but once you sign the term sheet, you're kind of bound to that investor for some time. To what extent can you negotiate before actually signing a term sheet?
That's exactly when you should negotiate. When you have a couple different people who you're talking to and they've all expressed interest to you, maybe they've given you different term sheets, that's exactly the time when you should be going back and forth between them and say, you know, I really like you, but this other person's giving me better terms. Can you help me out here? That's exactly when you should be doing that work.
I see, but some negotiations happen after the term sheet, which seems like the purpose of the term sheet.
So the negotiations that you think you can improve upon really should happen, you know, before you sign your particular term sheet.
Okay.
And it depends a lot on whether or not you have multiple people competing for your rows. If you have several different people who you're working with, you're probably doing a lot of that negotiation up front before you sign a term sheet.
Okay.
If you're working with really more with one person, that may happen after you sign the term sheet.
Thank you.
Good question. There's a question off to the left. They're going to want to get to you with a microphone. I can also repeat questions. There's folks online is the reason we're running around with microphones, if they didn't mention.
If I've seen deals where you have like 2 or 3 VCs syndicating. So if you had that type of arrangement, would you have one term sheet or one term sheet from each?
Almost always there's going to be some lead investor. And the lead investor is going to write the term sheet. And the most important thing that they're doing in that is valuing your company. That's what really takes a lot of the hard work, is to be able to say what a given company is worth. And so often there will be sort of one lead who writes the term sheet and others will follow onto their term sheet. So in that case, if they're all cooperating, you'll get one term sheet and not many. Sometimes VCs can co-lead. That's a situation that happens too. When you're getting multiple term sheets is really when VCs are competing with one another rather than cooperating. There's a question off to the right.
Yeah, so what is it? I mean, it says it's not legally binding except for the no shop provision.
Yep.
So why, like, if nothing that follows is legally binding, is it just a framework that you're going to agree on individually later, or what's the point?
So this is basically the blueprint, right? So we're trying to agree on what are sort of the foundational terms of our agreement before we hand it off to a lawyer to write up all of the very detailed legal language. So this is, you know, as you go through this, it'll read a little bit like legalese, but you should, you know, it's nothing compared to what your definitive agreement will look like. It's just enough that you can agree on sort of the business principles that you're agreeing to, if that makes sense. So this is, again, sort of the blueprint is, I think, the best way to think about it. And a question up front?
So sorry, I'm a little bit confused. Please clarify. So one would sign the term sheet at the time you've agreed to begin negotiation or after negotiation?
So you can negotiate before and after, is the short answer. If you have multiple term sheets, the best time to negotiate is before you sign those. After you sign a term sheet, there will likely be more things that you talk about. So in all likelihood, the answer is both. You will negotiate both before and after to some degree.
So it's not a binding agreement?
It is explicitly not a binding agreement.
But I would say just generally, if you're signing a term sheet, what is agreed to in the term sheet is the starting point, and it's what you're silent on that you're negotiating after you signed it. You generally don't change the terms in the term sheet in good faith unless you're horse trading stuff.
Yes, that's fair to say. So let's keep going. There's going to be a lot more specific terms that we can talk about here, and we can take questions as we go. So we're going to proceed sort of through the term sheet here in order, taking the terms as they come. The terms that we're going to talk about today, you can put into sort of 2 broad buckets. One is going to be economic terms, which covers, you know, what the investor is buying for what amount. And then the other set is going to be control terms, which talk about who, you know, gets to make what decision in consultation with who. And so this first section here, the offering terms, is the economic terms. This, in a lot of cases, is going to be the primary focus of negotiation. And you can see how the language is written, but when you have a conversation with your investor, really what you're going to be talking about is the pre-money valuation, the amount of the round, the amount that they contribute, and the size of the option pool. And so walking down those, pre-money valuation talks about what is your company worth today before any money comes in. That's the work that they do to value your company. The size of the round is how much are we adding? And the third is how much is this lead going to put in? So if the syndication situation that was talked about earlier comes up, you may have an investor that says, we're going to do a $2 million round. I will do $1 million of that. And so that's how those two things are different. This is going to be sort of the focus of a lot of your negotiations between the VCs as you initially get your term sheet here. This is sort of the primary set of valuation terms. Any questions, thoughts, reactions here? There's a question up front.
How is the interest rate determined? Is it like a market rate plus a margin? Is it just the VC says, we want to make 30%? How do you figure that out?
So this is going to be a priced equity round, so there's not going to be an interest rate that's involved. So this is just going to be a purchase of equity in your company.
Oh, I see. It says principal and interest on the bridge loans. Okay, got it. Thanks.
Great. In some ways, this section is very straightforward, but this will probably be a significant part of the discussion that you have. One sort of point there on the end, especially when there's lots of pre-existing notes like those convertible notes and the safes that we mentioned earlier, it's really helpful to put together a pro forma, which is just a projection of what the ownership of the company will look like after the money comes in, just to make sure everyone's very clear. There's a question up here in the front.
Yeah, it's actually kind of on that line. If you have an existing safe in place and you're doing your first priced round,
Yep.
How do you think about the economic terms to make sure that you're, if they say it's a $8 million pre and you've got safes in place, like how do you make sure you get the math right? Like, is it really an $8 million pre, or do the safes alter the pre and post money valuations?
So the terms that the investor doing the round gives you are going to be what they are. So it depends a lot on the specifics of the instruments that are used here. There's pre and there's post money safes. There's different ways that you can write whatever the pre-money valuation includes. But no, it isn't the case that I would say that the pre-existing safes or notes sort of changes the valuations in the term sheet necessarily. There's a question in the front right here.
Say you have like a 200K convertible note and you're trying to raise something like 2 million. Can that sort of turn off investors because they're thinking, well, 10% immediately just sort of vanishing back to original investors?
I would say in general that you having existing notes and safes isn't going to turn off investors. I think especially if we're talking about an investor who does primarily Series A work or something like that, it's going to be very common that companies have taken some sort of financing on instruments like that prior.
Yeah, okay, thanks.
Great. Oh, question in the front left.
Do you want to comment a little bit on employee pool?
Sure. So I think there's going to be a section where we talk about this a little bit more, but very commonly part of doing it on a large priced round is going to be setting up a pool of options. Most all the employees at startups are given some amount of options in the company to incentivize them to work really hard and make the company valuable. One of the things that investors in a Series A round are going to want to make sure is that there's enough of those available to give to new people who you have to hire. And so one of the terms of the round is very often that we're going to set some percentage of the company aside as an option pool. You'll sometimes hear it called ESOP, for employee stock option pool, to be able to make those option grants to employees. You should think about making this really pretty healthy if you still have a lot of hiring to do, especially if you have to hire a bunch of senior folks. If you're the two founders and you have to build a whole team, you should really make sure this is available. On the other hand, if you have most of your team in place and there isn't much hiring that you need to do in the short term, you might not need to make this quite so large. Good questions.
Just sorry, real quick to add a little color. As a founder, the biggest surprise to me was option pools change the price it sort of makes it more expensive the bigger it is. the more diluted you get. So,
So-
it's a surprise for me, or was a surprise for me.
So what he's talking about here is that very often this option pool is going to be included in the pre-money valuation of the company. And so if you are the founder and you're getting an $8 million pre-money, the percentage of that $8 million pre-money that's made up of option pool is going to change what you as a founder experience in dilution. Now, one of the things I've heard said is that a good conversation around option pool should be around what I said around incentivizing employees. But there are, if the conversation goes in a bad direction, it can, be used as a tool to effectively change the valuation of the company. So be aware that an option pool is something that's going to need to be put into place. Have an open and honest conversation with your investor about it. Conversation off the floor.
Yeah. Also, there's plenty of seats available in the front. So I just wanted to put that out there.
Very briefly, can you give a ballpark size of what a typical option pool might be? I know there's significant variation depending on industry, but a ballpark level. And then secondly, can you address compensation to the founders? Like how important is it that does it matter if they receive compensation normally or?
Sure. So there's two questions in there. First one around ballpark size of option pool. You're absolutely right that it depends very, very much. It depends on the industry. It depends on the size of the company. So, I'm usually very hesitant to give specific numbers here. Somewhere in the 10, 15% range is probably where you are. You can go up to 20 if you have a lot of hiring to do and if you have to bring on a lot of folks, but that's probably what you're looking at. The real danger in putting it too low is that you're just going to have to go back and create it later. And so, employees are always going to have to be given stock options. It's just when you create the pool that is going to compensate them. And then in terms of compensating founders, lots of views around this. I would say that at minimum, there are employment laws and that your company is technically breaking the law, even if it's only you, if there's no victim, if you're not paying your founders anything. I would say that, lots of different views on, whether founders should be compensated primarily through the options that they have in their company, whether, there is salary, that should be, at above or below market. So, very large range of different sorts of theories there and different ways that that's looked at. And of course, it's going to vary with the circumstances of the particular founder. If you're dealing with someone who has exited 3 companies already, they're probably going to be interested in very different economics than someone who is spinning out of a lab here in town. So,
how important is it to think about these things before you engage the investor versus after?
So you should have a good idea of what's important to you. Even before you go into your fundraise, you should have a good idea of, some of the things we've talked about are very predictable. You probably have a good sense of how many people you're going to need to hire. You probably have a good sense of whether or not you're going to need to be paid a salary, sort of where you are in your life outside of work. And so you should have a kind of a good idea of what's important to you and where you can, where you're willing to give, where you're really not. I would say that a lot of the specifics will come up in the negotiation, and you shouldn't worry about having too detailed a plan too far in advance. You're not going to be the one proposing the term sheet, so I'll put it that way. Good questions.
Going back to the option pool, is the best way to think about it for that specific raise, or do you need to think about it like, say it's the seed round plus a Series A, Series B, because eventually it gets smaller, or I don't know. How do we think about it?
Usually the former. Usually, at future raises, you're going to take a fresh look at what the option pool is. And so you shouldn't try to plan too far in advance with your option pool. You should think about the hires that you need to make before you get to your next round.
Okay, great. Thank you.
Great questions. Okay, let's jump forward. We can keep going with questions here as we go along. So the last slide talked broadly about what do you get for how much. That's what the primary economic terms talk about. This is talking about dividends. And so this, along with the next slide here, which is going to be around liquidation, are basically going to talk about what happens in particular liquidation scenarios. And so First thing you should know about dividends is that early stage companies generally do not pay regular dividends, not in the way that a company like on the Dow or the S&P 500 does. Like, early stage companies are very cash hungry. There's not a lot of cash on hand. No one is getting dividends at a particular rate. What we're really talking about is whether or not in sort of modest exit scenarios, the investors get some sort of preferred return on the capital that they're investing or not. And so you can see in that third bullet point there, option 2 in the legal language says that they do, and option 1 says that they do not. The option 3 is a very rarely used one. I don't really see that one come up very much, if I'm being honest. And so where these are really going to come into operation is if you have sort of a modest exit scenario. If the company winds down, there's no money to pay anyone, dividends don't matter. And if the company is wildly successful, then the dividends are a very, very small portion of all the money that's being paid out. So in neither of those scenarios are dividends really very important. When dividends really do come into operation is when you have sort of a modest exit. When you're selling the company, things went good, maybe not great. That's when in the case of investors having that preferred return, there's going to be a little bit more of the capital that goes to them versus the founders. I'm going to keep going here just because liquidation is a little bit connected to that. And again, this is looking at how is valuation divided in wind down and in exit. And so this set of terms here basically talks about what has to happen to the preferred shares that an investor holds to get, for them to get capital again. And so the first thing you should know is that while founders are going to hold what we typically call common shares in a company, investors are going to hold preferred shares. And what puts the preferred in the preferred shares is this provision here, the liquidation, which says that they get capital back first if the company is liquidating or winding down. That's what it means to hold preferred shares. And that's very, very common. That's how most all shares are going to be written when an investor is coming into your company. Now, the first alternative says that investors must convert their preferred shares to common to receive upside returns. So this is talking about exiting the company here when the company is sold and there's, say you're having a good exit, in order for the investor to receive returns that are sort of in line with all the other common, they're going to convert their preferred shares to common shares, everyone's going to be happy. Alternative 2 says that investors can receive preferred returns and get the returns on the common. This is called participating preferred. It's a little bit out of style these days. It's a more investor-friendly term. It means that they can basically have it both ways. They can keep their protected preferred shares and also participate in your common in the case of an exit. This is a term that a lot of founders try to get out of their term sheets, try to argue against for some good reason. It's very often referred to as double dipping because investors do get to keep their preferred and participate in common as well. That's what that second alternative is covering there. Alternative 3 is somewhere in the middle of those two things. So this is a secondary focus of negotiation, typically to those primary valuation terms. But these two together, as I said, the liquidation terms and the dividend terms are really covering mostly what's happening in those intermediate scenarios. Really, like I said, in the wind down scenarios, these aren't very important because there's no capital to return to anyone. And in the very high outcome scenarios, there's so much capital returning to everyone that these aren't really going to change the economics very much. But in the middle is where they come into operation. Quick questions around the room. Question in the back right.
What would you say are the two terms that turn off investors when they see conditions from previous groups that have invested, say in a seed round or a late seed stage, and you have an A-round negotiation, but the terms that were negotiated previously may not be appealing to them?
Yeah, a really good point is being brought up in the back there is how do terms set in earlier rounds affect the terms of later rounds? And the answer is that very rarely will later round investors take terms that are worse than earlier ones. So especially in early rounds, it makes a lot of sense to try to negotiate hard against terms that you do not like. Because Any terms that you don't like in your seed round will likely show up again in your A round, et cetera, et cetera, et cetera. And sometimes they will sort of snowball more. And so a really good argument, even to your seed investor, for why you should not include things like participating in preferred, that alternative to there, is that all the investors who come after are going to ask for the same thing. So very good point being made. Good questions. Let's keep going. So up until now, we've been talking mostly about economic terms that talk about who gets what, for what, and what happens in different sorts of economic scenarios. This is the first language here that's talking about control. So this is talking about who gets to make what decisions. And this is one of sort of the lightest of the control terms here. It basically establishes that there is a board presence for investors. This is relatively non-controversial. There's usually going to be a board that's created as a result of an equity financing. One thing that's important to note is that the board composition is going to change pretty much with every investment round. So you shouldn't worry too much about whether your board is going to be the same board that you need to exit your company in the future or something like that. This is a board that you should think about being the right set of people to help you make decisions, to help you give advice for the next phase of your company's growth. Question up front.
Is it establishing the size of the board? Talks about the investors' presence on it.
So the question was whether or not this establishes the size of the board and the investors' presence on it. So this is one of a couple different terms in the term sheet that's going to cover a board. Collectively, they establish, or often establish, the size of the board, who's on it, and why they are on it. So in a common board structure of 5 people, it'll say, there is a CEO seat, and there is a seat representing the common stock, and there is a seat for the Series A direct. It'll say, and it may say, the CEO is Jane Smith, et cetera. And so there's very often going to be language that specifies a lot of that very, very explicitly. Doesn't have to, very often does. Great. So next, again, in the control terms are protective provisions. And this is basically a list of important things that are important enough to require investor consent and a threshold of the investor ownership that is required. This list generally includes a lot of things that would dramatically change the value of the company or its business. You can see some of the things that are on there are listed in specific detail, but it gives the holders of the preferred a right to veto certain types of decisions. It would be things like selling the company or taking on major debt or changing the nature of the business, things that are very fundamental to the value of the investment that's been made. This is relatively non-controversial to have in here, but you should take a look at what all of these things are. There's sort of a standard set of things that are, again, like selling the business, taking on new money, et cetera, that are pretty non-controversial. Some people try and add things into here. And you should just be very comfortable that all of the things that you are adding to this list will be things that you need your investors' permission to do effectively. And you should also set the percentage threshold here very carefully. You should have a good sense of, after you have those economic provisions, who's going to own what percentage of the preferred, and which people or groups are going to be required to trigger these things. Basically, if you set this percentage too high, you need consensus among your investors for certain things. If this percentage is set very low, then single investors might be able to block you from doing certain things in ways that you wouldn't like. So think, again, just pretty hard about how the percentage is set here. It should be something that you choose with a view on what that actually means. You should have the pro forma in front of you as you make this choice. A question up front to the right.
Yes, this is something has to do more with the previous slide.
Sure.
Normally, investors, how much effort do they exert in the control they have in the company?
So I would say that it very rarely happens that investors come to use what you might call hard power. I would say that very often in board meetings, there's a lot of discussion. There's a lot of people trying to influence the founder to do certain things or make cases for certain decisions. I would say that quite rarely are your directors or your investors going to force you to do something. Usually, the relationship is going to be something that's hopefully a lot closer and a lot more conversational than that. But a lot of the legal agreements are often written with a view to what happens in the worst case, and so a lot of what we're talking about is who would have that hard power if it ever came to it, more so than what often happens.
Thanks.
Do you want to talk to full ratchet versus partial ratchet?
So that's going to be, that gets its own slide. It is the next slide, so we can jump to that next. So this next slide is back on the economic side, mostly on the economic side. And this is called, a provision called anti-dilution. And it basically covers, intuitively, what protection, if any, investors get in the case of a down round. So if you have a company that just goes up and to the right, that you're just raising money on higher valuation after higher valuation, these will never come into operation. But, economy goes up and down. If you are raising money in the future at a valuation that is lower than your prior investors put in money, what this set of terms says is basically what happens to the shares that they hold. Because those earlier investors, their argument goes that they are taking on at least as much risk, if not more, than the new investors who are coming in. So they should get terms that are at least as good. That's kind of how the argument goes. And consequently, this anti-dilution provision say, if you raise money at a lower valuation, our shares should get more valuable. And so, or our ownership should get more valuable. And how to accomplish that is basically what these different alternatives detail. So I'll cover alternative 2 first, because that's the one that was just mentioned. This is called the full ratchet, colloquially. It is basically, it's very simple in what it does, but it's also very strong. It basically says that whatever share price you sell your new shares at, we're going to take that price. And now that's very strong, because say that you need just a little bit more money to bridge some gap that you couldn't have foreseen. All of the, if you're taking another $100,000, maybe the $5 million that you invested all resets in valuation as a result of that. And that is very, very dilutive to the founder, both because you're diluting from the new capital and because all of the capital that you've previously taken suddenly dilutes you as well in this very strong way. Now, how alternative 1 tries to balance that a little bit more is to say we're still going to give some anti-dilution protection, but we're going to consider both what share price you are selling new shares at and how many new shares you're selling. So if in this situation where you just need a little bit more capital to bridge that gap, there's an equation here. You can read it later. It's a lot of fun. We'll basically just say we're going to consider that as well, and we're not going to dilute you quite as much as if you had taken on a lot of capital at some lower valuation. That's sort of the intuition for what these two things do. I would say that this alternative 1 is very much market right now. It is what we see in the majority of our term sheets. Full ratchet is very investor friendly and has not typically been included in term sheets that we've seen, at least in recent years, although there is a historical precedent for it. So the third alternative is just that investors get no anti-dilution protection. I would say that this is a little bit less common in our experience as well. So questions on anti-dilution? The last thing I'll say about anti-dilution is that although it is primarily an economic term, it does affect some of the governance as well. You saw in that last slide as well that there is a sort of fractional percentage of ownership of preferred shares that is required to do certain things. Anti-dilution will change who owns what percentage of those preferred shares, and so it has some implications there too. Not usually the reason that it's designed, but an effect that it has. Great. So those are a lot of the most important elements of the term sheet that are going to get the most conversation when you're going back and forth with your investors. This is a subset of the full term sheet, but the ones that we're going to go through next are ones that may not get quite as much consideration, and so we're going to try and go through them a little bit faster. I've generally tried to group them into ones that are more standard and typically discussed less versus ones that are less standard and typically discussed more. This is a really good place to remind you that this is one person's opinion and that you should not take this as gospel and that every financing is different. So with that, jumping into some other charter elements. One is optional conversion. Very typically standard, it basically says that investors can convert their preferred shares to common. That's something that is generally giving up rights for investors, and so converting to common is not typically done. It's typically done at exit so that they can participate in some sort of upside that you're getting as a result. Mandatory conversion says that investors are required to convert their preferred in certain scenarios. One of the most common is an IPO, basically just so that investors cannot block a public financing. Again, fairly standard, something that everyone should agree to. Jumping down to the non-standard, the first one that's listed here is a term called pay to play. This is a more founder-friendly, more investor-negative, I guess, term that says investors are obligated to purchase their pro rata shares and face some penalty if they don't. Often it's the loss of anti-dilution protection or forced conversion to common. This is basically a term that's put in if you think that you're going to, really need your investors to do their pro rata in order to raise future financing. It's put in sometimes when the lead wants to obligate all the people who are coming in with them, and that sort of collaboration scenario to continue to participate in the future. It's one that again is not seen in all term sheets but comes up sometimes. Another term that is here is the redemption rights. This says after some amount of time, investors can redeem their shares at cost. It's rarely used. It's basically says that we're going to make no return on this, but we want our money back. And it's often a tool to force some sort of action on the part of the investors. Again, it's used even less than it is written, but something that is on the term sheet nonetheless, and so we're mentioning it here. Questions, any of these? If not, we'll keep going. So the next set of terms are going to appear on the stock purchase agreement part of the NVCA term sheet. Again, we're trying to group them in the same sort of way. The first is representations and warranties. These are very often on the part of both the founders and the investors, and it's basically just to say everyone told the truth during diligence. Sometimes you're going to put specific things in there that are were key points for you, but very common that you're going to have some reps and warranties on there. One important thing is that reps and warranties become sort of have legal force. They're going to be incorporated into the eventual agreement in that way. And so they should be, they're things that people basically can sue each other based on later if you lie. It's important as a founder that you make reps and warranties on the part of the company, not on behalf of yourself. So that's, I guess, the one thing that I would note in reps and warranties. Next is conditions to closing. This is basically just to say, again, a term sheet is not the final agreement. There are some things we still have to do. And sometimes this will spell out specific things that still need to be done. Very often they are at least financial and legal. And then third, counsel and expenses. This is basically going to say a lawyer is going to draft the final document and we are going to pay them. Very often it's going to be paid out of the financing itself, just standard way it tends to be done. Last provision here that is sometimes but not always included relates to CFIUS. CFIUS, if you have not heard of it, is the Committee on Foreign Investment in the United States. It's often advisable to do this when your investors are non-US based, when the money is coming from somewhere else. And this may be mandatory if your company is involved with certain critical technologies. So if you are making rockets, if you are making anything that goes into the defense industry, if you are making even certain critical technologies is written pretty broadly, the committee has jurisdiction over that. And so even if you're making, say, like cool semiconductor technologies or things that might go toward economic security, important to at least check to make sure that you don't need CFIUS approval. Any questions here? Question in the front right.
For the counsel and expenses,
yep.
Does the do the investors in the company have to find sort of an agreed upon firm, or do investors just say, oh, we leave it up to you, company? I don't know.
Often the amount, there's a cap on the amount of the expenses. No more than $20,000, whatever, is going to be specified here, but a firm usually will not. Usually that's something that you may discuss outside the term sheet, but it's very rarely going to be written in.
Okay, and then the selection of the firm, could it go either or? Like, say, an investor might say, oh, we prefer this shop.
If you ask them, they will almost certainly have one. You can also find your own. I would say that, as you get closer, like having a relationship with a lawyer before you really go into here is probably a good idea.
Yeah, okay, thanks.
Great. We'll jump forward again. This is the investor rights agreement. So again, starting with the more standard. The first one are registration rights. There's actually a few different terms that go under there. But this basically says that when the company is public, the common shares that investors would get from converting their preferred can be registered for the SEC with for public sale. Basically just to say that when we become a company, you'll register our shares for us and we can eventually sell them. It's fairly non-controversial. If we get to the IPO, everyone's happy. Like you're never going to mind sending a piece of paper to the SEC so that your investors can sell their shares. The trade-off for that is that the investors typically agree to a lockup period post-IPO where they aren't allowed to sell their shares. It would look really bad if you IPO'd and a bunch of investors dumped their shares the next day. So there's typically a lockup period that prevents that. Again, fairly non-controversial. Second is management and information rights. This basically says that investors are entitled to a set of financial reports, usually quarterly or annually, and with reasonable notice they can come to your facility and talk to your staff. So the first set of financial conditions, very standard, very non-controversial. We need to know how the business is doing. Second set around coming to your facility and talking to your staff are up for negotiation a little bit more, especially if you work on something that's highly technical and proprietary. And bringing back CFIUS review, if you work on something technical and proprietary and you're taking on money that is coming from outside the US, one of the things that CFIUS might require is that you limit these information rights in certain ways. So having information rights, especially on the financial side, very standard. On the sort of company information side, a little bit more up to negotiation. Jumping down again, we have pro rata. So this is basically the right of investors to contribute to future fundraisers. And the pro rata right says that you have the right to contribute to future fundraisers at the level necessary to maintain your current ownership. So if I own 10% of your company from the Series seed raise, and then you do a Series A, I have the right to give you whatever number of dollars I would need to keep 10% ownership in the company. Again, this is a good place to remember that all future fundraisers are subject to negotiation and terms may change. So if you have some investor in the future who says, I'll invest in your company, but I need to take your full round and your investors can't do their pro rata, a lot of times your previous investors probably aren't going to block that. That's the sort of thing where you'll have a conversation. But there is a legal right that's often written into the agreements at least first pass. Last item here is matters requiring investor director approval. Investor board members must agree to certain things. This is a different version of the preferred voting right that we saw earlier, the other control terms that came under protected provisions. This basically says that investor board members must agree to certain things with a major impact on the company. Again, big things like taking and making loans, hiring, firing execs, company pivots, partnerships, really, really large decisions. The big difference you should keep in mind between investor director approval and the protected provisions is that when things are under investor director approval, your investor is acting as a director of the company, which means they are a fiduciary, which means that they have to put the best benefit of the company first. When they are acting as investors under the protective provisions, the other section that we saw, they are not. Directors are fiduciaries, investors are not necessarily fiduciaries. That's the main difference between an investor director approval and protective provisions. Otherwise, they operate in much the same way. But I'm getting time signals from the back, so I'm going to keep moving. Please feel free to continue to jump in with questions. Continuing on the investor rights agreement, the first term here is non-solicitation, non-disclosure. Fairly standard. It's basically that any confidential or IP belongs to the company. Very important, especially in companies where that is sort of the foundation of the value. The founders agree that they're not going to quit tomorrow and poach all the employees and companies and other key relationships and basically stand up the company outside. So relatively standard set of terms. These are related to the non-compete, which was once pretty standard. They've become a lot less common these days. You've probably seen that in a lot of the news. A couple of the most sort of entrepreneurial states have either banned them in the case of California or restricted them significantly in the case of Massachusetts here. A lot less common, they still do happen, but the non-solicitation, non-disclosure, fairly standard. Board matters, again, fairly standard. Board of directors will meet regularly. Cadence is often specified. Company carries what's called D&O insurance for the directors and officers. That's good for both you and your investors that, if the company gets sued or something like that, you're not all personally liable. Employee stock options, we talked about this already in creating the pool. This is often going to specify a standard vesting timeline. If you haven't heard already, a very, very common timeline is a 1-year cliff, 4-year vesting, which means that you get, as your employees are given options, they vest none of them for the first 12 months. And then at 12 months, they invest 25%. And then they invest their options usually monthly over the next 36 months. That's a very, very common vesting schedule. Last is key person insurance, which is, again, just protecting people who are critical to the company. Question in the front right, I see.
Yeah, just have you ever heard of people putting expiration values in the sheet? So if an employee leaves, a 90-day expiration or longer.
So you may be talking about something that operates similar to the cliff. The cliff vesting typically means that if a company leaves in the first 12 months,
they don't get any of the options.
None of their options are vested.
I get that. So let's say you leave 2 years in.
Yep.
You have a pile of options.
Mm-hmm.
Normally, I've seen, you have to either exercise them or abandon them after 90 days if you leave the company for any reason. I just saw a 10-year expiration, which I never heard of anything like that. I thought 90 days was standard. I was just curious if that's written in, or how did the founder get 10 years expiration?
I understand. Yes, you're exactly right. That very often, maybe not in the term sheet, maybe in the other sort of constitutive documents of the company, there is often an expiration for options, which says that you have to purchase, if you leave the company, you have to purchase them in some amount of time. 90 days is quite common. 10 years is quite unusual. I wouldn't quite know exactly what led to that. But again, every financing different.
If you're a Delaware corp working out of Massachusetts, do those provisions apply? The non-disclosure, non-solicitation, non-competes?
They're going to be, so the provisions are whatever you agree to. They're ones that are very often going to be written for exactly the sort of corporation that you mentioned, Delaware-based corporation working in Massachusetts.
I was just wondering, is it common with the employee stock options, or is it controversial to have a clause that accelerates the vesting if there's a liquidation event?
Those clauses can definitely be written in. So again, you're talking to a seed stage investor, so I'm not very often thinking about, our companies exiting in the very short term. But yes, you can have a single trigger or double trigger acceleration. Those are things that I think any of the lawyers that you'll be working with would be happy to discuss in more detail.
I guess a question would be, how much do the investors care? Is that an important thing to them, or that's a minor point?
Depends on what stage you're taking money at. If you're taking money at seed stage, not going to be something that we really talk about. If you're taking a CD round, where exit of the company is maybe imminent, might come up much more highly in the conversation. Is there a question, or?
I was going to try and help you out. 10 years is the maximum statutory period for options, and I'm happy to answer questions on options afterwards.
There we are. Lawyers happy to speak to it, as I mentioned. Very good. Continuing to try and power through here, some investor rights provisions that are not always standard. Limitation to CFIUS exercise of rights. This, as I mentioned, that CFIUS group might say that we limit information rights, for instance. Springing CFIUS covenant is basically just to say if CFIUS asks, if we need to do a filing for them, everyone's going to cooperate. Investors aren't bound to accept the conditions here. Basically, if they decide they want to step away instead, they can. And then limitation of information rights sometimes comes up, again, for highly technical companies where we're protecting some sort of IP from some sort of concern. Right of first refusal voting agreement. So these are a couple different types of agreements here, fairly standard things. Investors typically have right of first refusal on common stock sales by founders and employees. This is mostly important in managing the cap table, basically making sure that no one gets onto our cap table without investors being able to have some say in that. Board of directors, this was a question brought up earlier around what is actually specified. These terms here are going to, together with the ones mentioned earlier, going to name often the size of the board, who is on it, and why. Presence of a board is standard. The composition of it, very much negotiated. Next point here is drag-along rights. This is basically to say that if we are going to exit, if some majority of the investors and the stockholders together decide that they want to exit, the rest get dragged along. basically to say that a minority cannot stop a sale that most people want. You should be careful in setting the level of what majority means, and you should be careful in setting the group of people who you're reading that over. You as a founder want to make sure that you are included basically in that, and it isn't just your preferred stockholders who are going to get to make that decision. But in general, a positive provision for both sides, just to make sure that, again, we can't stop that we can take minorities with us and that they can't stop us exiting a company that most people want. Last on the bottom is sale rights. This is basically just to say that if some majority of preferred investors agree, they can force a sale of the company. Not standard, but written into some term sheets. I think we are getting to the end here. This is the other matters section. The top one is around founder stock. This is basically to say that founders are also subject to a vesting schedule. One thing that often happens, again, in later rounds, I'm an early stage investor, so less so in my case, but one thing that sometimes happens is that investors will ask founders to vest some percentage of their stock. And that's a thing that often happens. We think that it's most fair when you try to balance both incentivizing founders to stick around and also recognizing that they have done a lot of work up until that financing. Next provision is the no-shop confidentiality. This is just to say after accepting a term sheet, you're not going to solicit other offers for some period of time. Expiration, pretty self-explanatory. Term sheet expires technically at some day and time. As we mentioned earlier, very rarely is the discussion going to fall apart because of this. This is mostly giving your investor a legal out to step out of this. Remember that as long as that expiration hasn't hit, as long as you sign their term sheet, you're moving into the next stage. And so this is mostly to say, to give the investor an out. Bottom here is existing preferred stock. This is just to say that if the company has some existing preferred stock, the final agreement might change some of its terms. Broad point to keep in mind is that most future financings will rewrite some of the legal docs you've already signed. I think we made it through. Any final questions? Well, we are only slightly behind. They didn't get out the gong for me just yet. But thank you all so much for coming to our session. My name is Jeff Knox. I'm with InnoSpark Ventures. I'll stick around for a couple minutes if there's any other questions for me. Otherwise, please enjoy the rest of Boston Startup Week. Thank you.
Yeah, quickly, please, before you head out, again, thank you so much for coming out. And we have a lot more for today and the rest of the week. And we also have a welcome party presented by HPE right here at 6 p.m. at